One of the biggest misconceptions in trading are gap fills and what they really mean and what they really do. So when you look at this chart on NVIDIA, you can see on Friday that we got above 106.4. And it doesn't really matter when this was. It'll give you an example of why you need to look for these things, right? So you have a gap to the upside, which you filled. But what's funny enough is you had a gap to the downside. And so some people get caught up like, where are you looking for and where are you looking for that action to go? Now, for me, what I'm always looking for is continuation with the trend or the direction we're moving in. And you need to understand what these gaps really mean. It's just a lack of liquidity. So if I just draw back the VRVP, looking at the visible range here, you can see there's no liquidity above this like 106.8 all the way back into 110, 111 minimum. But then you also get the gap fill, right? And if you look back to the downside, you have a lot of liquidity here, but really once you start breaking below 102 to 101, you have no liquidity back down to 98. So that's what those gap fills mean, is that you just don't have a lot of buyers or a history of sellers showing up in those spots. So what you're expecting is when you get in those illiquid ranges is for quick moves from point A to point B. And those are typically some of the best setups that you're going to get intraday trading stocks, futures, whatever it may be, because again, you're getting those really quick instant moves. And again, the risk to reward there also stays pretty good, right? So you always want to be putting yourself in that situation of you're risking the least amount to make the most. And that's what these illiquid zones really do, is they paint you a clear direction of where you should be moving and how fast you should be moving there. Follow for more content.